They say that nothing is certain except death and taxes, but with the right knowledge, you can make tax laws work for you. Today, we're going to dive into the world of real estate taxes, from upcoming tax policy changes to tips on how to avoid paying capital gains tax.
Welcome to Elevate, where we explore the latest in elevated living. Hear from the local artisans, business owners, and innovators who make Las Vegas extraordinary, and whose stories and insights will help you live your best life. This is episode 3 with managing partner of BDO, Scott Taylor, a CPA with over 30 years of experience.
Scott, when do you pay capital gains tax on real estate?
The capital gains happens the day title changes. So if you have a transaction where you're going into contract, it's the day the title changes. Whether it's an outright sell at that moment or whether it's an installment sell, which you're going to receive the payments over a period of time, that's when it starts.
Got it. And it brings up a good point just as far as technical wise, if you're transferring the property to a family member or something, that could also be a point of gains.
Yeah, if you're transferring the property to a family member, it's a little bit more tricky. Are you gifting it or are you selling it? Is there a price for that? And then that just changes the character of the circumstances.
Got it. Well, we won't go down that rabbit hole right now. So real estate has been going up through the roof these days. So most sellers, when they're going to sell, are now making a good chunk of change, a good chunk of profit there. And, I think what we're going to chat about today a bit is the different options that might be available to people in terms of trying to lower some of that tax burden. So what's their best option to pay little to no tax?
The best option is to take advantage of living in that home for 2 out of 5 years. If you live in that home for 2 out of 5 years, it qualifies as your primary residence. Therefore, if you're married, you get an automatic $500,000 exclusion of the gain right off top. Years ago, you used to have to reinvest that into a new home. Now that's an outright exclusion. So you just take the exclusion and go on your way. If your gain is more than that, $500,000 if you're married or $250,000 if you're single, you have to then pay the tax on the difference.
And what rate? So if you've got more than $500K in profit and you qualify for that, primary exclusion, what is that extra rate? Does it get tacked on as ordinary income now, or is it a long-term capital gains, or has it got something else?
Yeah, if you lived in that home for 2 out of 5 years, it already meets the definition of long-term.
Okay.
But technically, if you live in it for a year, your job changes, it's still going to be long-term. So basically, a year and a day is long-term capital gain. The tax rates for long-term capital gains range depending on the rest of your income on your personal income tax return. So most people think that it's 15% flat. It's technically not, because it increases at about $450,000 to 20%. And then it adds on a little bit of Affordable Care Act. The long-term capital gain is at 3.8%, which is the the provision for the income or the health insurance benefits that we have.
So what does a property have to do to qualify for long-term capital gains? For example, I didn't live there. It wasn't my primary, or I only lived there for a year or less than 2 years, or I don't qualify for Plan A. So now it's Plan B, which is long-term capital gains. How do I qualify?
Well, let's say they speculate on it. They just buy a house. They want to go in and do a few upgrades on it. They get a good deal on the price, so they hold it, and they only hold it for a month.
Mm-hmm.
It's short-term capital gain, regular income. Just like your wages, the only difference is it doesn't have Social Security and Medicare on it, just short-term capital gains. But if you hold that property for a year and a day, it all of a sudden converts to long-term capital gain. So it really doesn't matter if it was your primary resident or not, whether you're just vacant. Got
it. So it could be vacant, rented, you could live there for a year and a day, and now it's long-term capital gains.
Mm-hmm.
Now, to go a little bit off the subject, different angle is when it's a loss. Now, I know in this market, people aren't really experiencing a loss, but I remember back when the market was down quite a bit, that there was a client that was going to see about $1 million loss on their primary. And in that case, they decided to rent it out to put it in service as a trade or business to ultimately be able to take advantage of a loss. So not that I really see that happening in this market, but just how does someone manage that?
Converting what was a primary residence to a loss and converting it to a rental, it gets a little bit tricky because it's the circumstances surrounding that property. Technically, when you place that property into service, it's supposed to be placed in service at the fair market value date of the date you start renting that property. There's a lot of professionals that will say, I've been in that home for a year. I really want to rent it. Market's kind of declined a little bit. What's the real fair market value of that property? As soon as you decide that and consult with your tax advisor, then you place it into service and rent it. That's where the depreciation starts. And that's where the benefit of having a rental property placed in service. If you then rent that for a year or two, you're pretty much home with running with that being a trade or business rental property. And therefore, if the market still stays down, you potentially have a loss that you can take, which is ordinary. It's an ordinary loss pretty much because it's a trade or business property
Got it.
because you're renting it.
So Monica, you had a client recently that
Yeah, I have a client out of Red Rock. She has a property in Red Rock, and she decided she was going to live in the property for a little less than a year and then rent the property for now what's a year lease. She's based out of California, so she doesn't live locally. So what are her options with that particular scenario?
Well, her options are if she's going to rent it, she's starting a trade or business. And technically, under tax statute, you need to start depreciating that property because you're in the business of renting now. Whether it's going to be short-term or long-term doesn't really matter. You start taking depreciation on that. She'll just need to watch for, hey, I've got to report this on my tax return. Since she's domiciled in California, it gets reported as California income or California losses, whichever it is. Most rentals at the first part have a lot of depreciation, ends up being a loss. So they have to deal with the carryover provisions of rentals are considered passive. So they get triggered and limited to the passive loss rules for rental properties. So that's something to watch out for.
And what is, just to break it down for us, what is depreciation exactly?
Depreciation is the full out-of-pocket costs that you have in real property reduced by the amount of allocation to the land and then taking the method of depreciation on that. The method for a rental property is 27 and a half years of property. Usually when you place it in a service, you talk to your accountant and say, okay, how much is the hard vertical property that I'm renting and how much is the security system or the lighting system or whatever other technology things you have on it. What about the pool? Is there a price you assign the pool? They get shorter depreciation lives. So usually take a look at that when you place a rental into service.
Ryan, to put it in a little more layman's terms as a real estate agent, it's basically if you buy a home for $1 million and the Clark County attributes a quarter of that property's value to land, you can only depreciate $750. Once again, these are broad strokes.
Yep.
For residential, it's over 27 and a half years. For commercial, it's 39 years. There's definitely more advanced accelerated depreciation schedules out there. But that's one of the really neat things that investment real estate provides is that depreciation because, depending on how much debt service you have, that might completely, or income and depreciation, you might completely offset your income to where you're getting income, but the depreciation sort of cancels it out. So that's where you get people that maybe pay no taxes on their income because they have this depreciation to count it as a loss. Now, after 27 and a half years, they're usually not tearing down the building and rebuilding it, which is kind of the purpose there, but that's besides the point. So depreciation is a really awesome thing when it comes to investment property. However, so let's just say she owns it. She lived in it for almost a year. Now she's rented it for a year. When she sells it, she's going to have taxes due in California. Is that correct?
Yep.
So nothing Nevada-based. And then what's recapture? What is that? How does that calculated?
What it basically means is you take depreciation deduction, and that is an ordinary deduction. So it's coming off of your ordinary income. It's basically a deduction against your wages, the deduction of all other income that you have on your personal tax return, so that you get a big deduction for that because the marginal tax rates go up to 37% now. When you recapture that, the marginal rate that is the maximum is 25%. So it's a win-win for real property is that you take it as an ordinary deduction at a potentially 37%. If you're high income, you recapture it at 25% for that depreciation recapture. And that's only for what you took the depreciation on, not the rest of the rental expenses that you had.
Got it. Here's another scenario for you, a little more complicated. So this is a property that is one of the family members basically bought half of the property and the other while the owner was still alive, and the owner passed away, and then the other half is now in an estate. Okay, so I believe the half that was originally purchased was, let's just say it's been 10 months. Okay, and now the person that owns that half is going to buy the other half from the estate and then sell it. So to get long-term capital gains, do they only get long-term capital gains on that half that they've owned once they hit the year mark? Or do they have to wait a whole year from once they own all of it? How does that work?
Well, I think your question is kind of, is there a tacking of the holding period for the period of time at the estate? And truly, everything that you inherit in the estate world from real estate is going to have a tacking of the holding period. So even though you might inherit it, a month later you might sell it, it's still long-term capital gain at tax to the estate. But if you're going to acquire an adjacent piece to make your property more appealing to an investor or some future development, that is the date of acquisition. So there's no tacking of that part of it. I think that's what your question was.
Yeah. So in this case, this particular case, even if let's just say they bought their half 6 months ago while the owner was still alive, owner passed recently, and now let's just say he buys out the balance of the estate tomorrow. Does his half have to be the year mark because he owned his half before he inherited it? Or let me put it this way: he didn't inherit any of it. He bought half of it before the person passed, and then he'd buy the other half from the estate. So basically, he didn't inherit any of it.
Yeah. So is this person the one inheriting the property from the man who's passed away?
No, he did not. The estate has its own heirs, so to speak, and he's not one of them.
Yeah. So his acquisition is the date he physically acquires the property.
So the fact that he may have owned his half for a year doesn't matter.
You would have a separation of long-term and short-term under those circumstances.
So you could do that.
Yeah. So you basically partition it out. It happens a lot with developers when they buy a piece of land and then they acquire another piece of land later. So there's a separation of what's long-term, what's short-term. And it's based upon a pro rata kind of allocation of, hey, what did you buy first? What did you buy second? And what's the percentage of that? Some may be the short-term and some long-term.
And I have another scenario, just to clarify, because I think you touched on this, but I just want to make sure. I have another client who purchased a property. It'll be 3 years ago in July. And he has spent this last 3 years completely remodeling this property. No one's lived in the property. He initially thought he would live in it, but now he's steering towards selling once the remodeling is complete. Where does he stand when it comes to capital gains?
Long-term capital gain, 100%. 100%. See, when you turn around and sell that property, then you identify, okay, what's part of the property that you held, and then what's the part of just fixing it up to sell.
The basis.
It gets a little bit tricky if you've put a lot of stuff into it, like the pool, like the landscaping. And then you might have some that is partitioned, but most things that you've put in recently is not what's appreciated. It's the underlying land or the existing property that you have that appreciated. So you try to argue what's the allocation of the sales price for when you have things that you've basically put your own money into and developed after the fact.
Right. And that's something where, when we were talking with appraiser Scott Dugan as well, the idea if someone's done renovations, especially to just have, whatever they've done, to just line item that, keep costs, keep a running tally going of what you've done. Because it helps us sell the house so people understand what's been done, whether it's new air conditioners, new water heater, et cetera. It helps the appraiser value the thing because they understand how much you put into it. But then I think it would help you to figure out, okay, how much have we increased the basis, right? Like you bought it for 1 million and you sold it for 2 million, but not all of the 1 million is profit because out of some of that you have to pay real estate agents and closing costs. You also spend another 300 on the pool and the renovations and the brand new kitchen, et cetera. So basically you bought it for $1 million, you put the 300 into it, so you're into it 1.3. You sold it for 2, but let's just say you had 100 or in costs for easy math, so you're now at 1.9 minus 1.3 gives you 600 in profit. So that's where that list would also help you when it or their CPA, right?
Yeah, I think the key is you got to be a little bit careful with what's defined as real property, what's structurally part of the property, and what's a personal property, which is maybe some electrical specialty or some lighting specialty or some land improvement. When you have those kinds of things, when you sell it, it's best to have a separation of the purchase price because there's really not appreciation to that kind of part of it. It's really, appreciation is the bulk piece, which is the real property. The other just helped it sell. So you like to say that's a wash. So you have basically personal assets which are sold, which is the computer equipment and so forth, technology. And then you have the real property, which is the long-term capital gain property.
Yeah. And generally when we're selling furniture with the house, we try and do it as a separate bill of sale. So it's just not subject to all the other cost of sale and transfer tax. And
because that's personal property. So there's really not appreciation to furniture. It's probably close to what you bought it for. So it's kind of easy to partition out.
So what's going on in the world of taxes as well, other than real estate?
Boy, there is a lot of discussion of what's going to be coming. Whether it's going to pass or not is another story, but there's a lot of things coming. First is the raising of capital gains rates, which we've talked about a little bit. There's discussion of moving that up to where it was before or removing it entirely. Years ago, it was 28%. We loved it when it was 28% because it was much better than 39%. But we also as tax people, we like 15 and 20% in there. But there's discussion of changing that. There's discussions of changing the provisions of the exclusions, changing the provisions of marginal tax rates. There's a lot of things that are on the plate.
So you say
changing mortgage deductions, changing charitable deductions.
Really?
So you're saying they might bring it back to what it was at 28 or remove it completely, you said?
Yeah, there was discussions recently to remove it completely, the capital gains.
And that would just stick everything at ordinary income, basically, which would obviously much more costly and sort of take away one of the big pluses of
I can't remember the year they actually took that away. It was something like 1990 something where it went to 28% went to 15. I think it was during the George Bush years. Went to 20%, 15% to spur the marketplace.
Got it. What's the current mortgage rate or deduction capped at?
$750. That changed in the Tax Cuts and Jobs Act of 2017, which was passed right at the end of the year. The first full year we saw that provision was in 2018 for tax purposes. So that surprised a lot of people. There was provisions in it that said that if you had a previous mortgage, that provision didn't apply to you, which was the old $1 million with $100,000 of home equity, which was deductible. But the new $750 is for new financing. So with the prices of homes now and the interest rates, that's very real with an everyday family almost, at least in Las Vegas and the West.
And that's $750 in aggregate total, whether this is primary and this is investment, et cetera. It's just like one.
For your primary residence, $750 is the cap. That doesn't have anything to do with your second home.
So what if
you can't deduct it if your second home because it doesn't qualify.
Got it.
Yeah.
And it doesn't matter for your rental properties either, but just with primary residence.
It's only up to $750 for your primary.
Yeah.
Okay.
Fully deduction. Doesn't matter what the rate is. Everyone's getting different rates now. It's crazy.
It's true.
Oh yeah, all over the place. So back to when it comes to selling and what we were talking about with increasing your basis and separating things out. When someone sells a house, should they talk to their CPA like in advance so they can better prepare? Or I feel like a lot of times everyone's just reaching out to ask us for their settlement statement again because they can't find it, and we send it to them. And I just feel like at that point, a CPA would have, hey, have questions and say, hey, I need this list, I need that. And now it's a house they sold 8 months ago, and now they're scrambling to figure it out.
Yeah, that's super important. It's vitally important, actually, if you're doing something right. If you're doing a real property investment and you're not sure what avenue to take, or just like your client did, what do I do after a year? What are my options? I got to do this improvement. I'm going to live in it for a while. It's more convenient. I don't want to rent another place. What do you do? How long do you have to keep your records? It's really good to think about talking with a tax professional and consulting about, hey, what do I need to be aware of? What can I plan for to help it? Because every circumstance is a little bit different.
Absolutely. And if anyone needs Scott's help, we just found out that he really likes the lobster mashed potatoes from Astros. So if you want to save some real money on your taxes, you know what to bring them to keep them happy. What are you seeing? Are you seeing any just mistakes or things people should be aware of, or maybe they're missing out on when it comes to just filing their taxes these years,
I think one of the biggest things I'm finding out is people that have owned real property for a while. Maybe they owned it when the Great Recession was on and they started renting it, and then it's now recovered and now they're going to sell it. And after they close, they're like, hey, maybe I should do an exchange. And it's kind of too late once you've done that. So you got to think about that kind of stuff beforehand, or they don't talk to their accountant and say, hey, what's my basis in this property after I've taken this depreciation? And then plan for him, how much do I need to set aside of this proceeds to cover the taxes and then go forward? That's the biggest thing, I believe.
Got it. So yeah, that's a good point. To clarify, a 1031 exchange is almost a different type of plan A, but for an investor where they can 1031 the money from, the sale into a new property to defer taxes. So a couple of things for clarification. One is, does it have to be an investment property? Or if let's say they lived in the home for 1 year and they said, okay, well, long-term capital gains is better than ordinary income, but I'd still just rather take all this money and put it towards another property. To do a 1031, does it just have to be in service as a trade or business, or?
It has to be investment property. It can't be your primary residence. It's super important. But there's plenty of gray area in there too. Sometimes people say, I'm going to live in my house for a period of time and then I'm going to convert it to a rental. What should I do with it? How long do I have to do this or that? And you get down to that point of anything under 2 years. If you fail that test of 2 out of 5 years as your primary residence, you're pretty much done with that discussion. And you just got to be careful with what you're doing with the planning. But it's super important to just plan for what your options are for that property. Real property is really important because under the Tax Cuts and Jobs Act, one of the most important things is real property was the only item left in the provision for possible 1031 exchange. A lot of people don't realize that. And so it's a privilege to not be what they classify as a dealer. I mean, if you have a whole bunch of rental properties, you might be considered a dealer. So you might not even be allowed to do an exchange. But real estate, if you can discharge or defer a gain in a high tax year for a low tax year, that's a great move.
Big time.
You be careful with what's happening in Congress with what rates are too, because it might be better, hey, pay tax on it now rather than wait for a higher rate in the future too. So it's a flip side.
Got it. Gamble.
And just to clarify, from what I recall, let's just say you had a property that you sold for $1 million, but you had a debt service of, like, you bought it for 500. And so just for rough math, your profit was 500. You have to, whatever you're buying in the 1031 as your replacement property has to be, equal or greater value?
It's value for value. And if you're relieved of more debt than you're assuming in the new property, that's considered to be a taxable, it's boot is what they say. It's like if I'm trading property with you across the table, I'm going to trade the equivalency. But an exchange is a deferral, meaning I don't know the third party. And therefore, to equate the transaction, usually there's something that makes it equivalent. And sometimes it's debt relief and sometimes it's cash. And that cash portion is taxable, or the boot relief.
Right. So once again, I think it comes back to what you're saying. It's a great conversation to be having with your CPA well in advance. obviously it can be of value to still talk to a real estate agent to get an understanding of the value of your property.
Mhm.
And hey, if you're not totally sure if you're going to sell it, then just be upfront with your agent and say, hey, look, I don't need a hard number. Give me a ballpark. Because an agent that's doing a good job is going to really look through the comps and sort out really, the views and the renovations and really but if you're just trying to figure out, hey, this property is in the range of 750 to 850, well, that's enough ammo to come to you, or their CPA and say, hey, here's where I'm at. Here's what's been going on. Here's what I might sell for, and then come up with the whole scenario of what. But I just think it's probably helpful for them to understand a realistic sales price.
I think it totally is. I think it's also good to look at what the marketplace is for right now. Inflation is through the roof. Real estate's probably the safest place to put your money, not necessarily cash. So it's a consideration to talk with your financial advisor too, to see, hey, what's the value of my money if I to keep this in real property, if the value of money is going down.
Mm-hmm.
Yeah, because that's a big thing. Just coming back to trying and comparing all your options, whether it's stocks or real estate or whatever else you're into, is once again that depreciation, factoring in not only what's your rental income or cash flow, especially if you're getting an interest rate, in fact, doing all that investor math, but then factoring in that depreciation to kind of get a better feel for what your real return is.
Yeah, just to hit on that for a second, depreciation in the first few years of a rental is almost always going to make you have a loss, especially if you have any debt on the property. So back to that passive loss rules, most of them are losses. So you're limited to taking that loss against other rental income that you might have, or it sits there until you sell it. So almost always you're going to get a big deduction for depreciation. Eventually, when it sells, even though you might be limited, it's going to trigger an ordinary deduction. And then that 12% savings on the depreciation recapture if you're in the highest income tax brackets.
Yeah, and that's where sometimes, look, it's not a carte blanche answer, but sometimes really having debt on rentals can actually really leverage your return because now you're not necessarily taking home as much profit, but you actually are, say, for example, you buy a property for $500,000 cash, or you buy a property for $1 million and you put $500,000 down. Well, that property for $1 million most likely is going to have a much more significant depreciation. Your income's going to basically should be the same in this, apples to apples here, because either way, you're just getting a return on your 500, and the money you're buying is sort of the extra rent you're getting because you bought the extra property is going to debt service in general. Like, this is a very rough, example. So it's like, even though it can be nice to own things cash and pay cash, that's one of those things where the debt on investment property can really juice things up a bit, because you just can really get this bigger umbrella of depreciation that can really help protect all that income that just came in.
Yeah, if you have debt with your rental property, you're almost always going to have at least a break even or a little bit of a loss, so no taxable issue. Yeah. What you just want to be careful of is the rate of interest that you're paying on that rental property and what your rate of return is on it. And whether you want to pay it off sooner or later, and what you can use the money for something else to generate, liquid, activity that's going upward. So it's a big deal.
Yeah, there's always, it's amazing to see some of these commercial properties and apartments trading at a 3% cap rate, which is just seems painful, because it's okay, maybe they're just banking on appreciation, because to me there's also risk with holding that property, and where you're starting to see CDs or tax-free bonds coming up out of the 0.001% range, those are at least a safer asset, and we're not trying to get into investments here, but just something to be aware of.
Have you seen, I got to ask a question for you. Have you seen with the rising interest rates, what is really happening with the real estate market? To see, that's what I view as something really important. You got people who had the false impression that they could buy a home for a certain price, and now all of a sudden they can't qualify. So it's going to affect things in a different way. And if you look at the peaks and the valleys of what those rates were, we basically have a blip of very, very low interest rates post-COVID and after COVID. Now rates are back to what they used to be.
Pre-COVID.
So it's the new norm.
I know, right?
But
Well, Warren Buffett had sort of a good analogy where he was, can't remember exactly how he said it, but basically like interest rates are like basically like the gravity of the market, where just like, hey, I could slam a basketball or dunk a basketball on the moon. Well, there's very little gravity there. So just as the rates got low, there was very little gravity, you know, it's sort of, so home prices, stock prices, everything seemed to drift. And now as, you know, rates are going back up, it's like gravity is going back up, which is now pulling equity
goes
markets
down.
back in, et
Yeah.
cetera.
very interesting.
So one last very serious question. Have you seen Top Gun yet?
I have not.
All right. Well, I recommend it.
I've
It's
heard
good.
it's.
I've heard it's good.
I've heard it's really good.
I haven't seen it either.
Cool. Well, it's been fun, Scott. Thank you.
Thank you.
Thank you, Scott.